On today's episode of Huge Profits, we're going to be showing you 3 ways to make $1 million in commercial real estate within 12 months. Over the next 12 months, there are certain things that anybody can do to put themselves in line to earn $1 million.
That's a bold claim.
It really is. And if I hadn't done it thousands of times for many, many folks over the course of the last nearly 30 years, I wouldn't be able to say it, but we've been able to
If I hadn't seen you do it, I would call bullshit. I don't know about that. Look, if you could just say make $1 million in 12 months, I think a lot of people listening have their ears wide open for this.
Well, I hope they do, because it's very actionable, and they don't have to do it at any level of exclusivity. You don't have to cut out any other aspect of what you're doing in your life. Keep your job, keep your family, keep your hobbies. All you have to do is start to incorporate some of the tools and the tactics that we're going to cover today to be able to start down that road to bring those opportunities towards you. And I got to tell you that today's marketplace is more ripe than it's been in the last nearly 2 decades because of the flexibility that's going on in the minds of sellers, people who own assets right now and what they're doing with them. The behavior and the climate within the banking model right now is completely topsy-turvy. They're very nervous about lending. The banking system's a little upside down. Interest rates are a little crazy. So those things cause investors to pull back from different asset classes, and commercial real estate's one of those. And then the third reason why I think it's more powerful now than ever is because the market's reset. We hit a recent peak and values have dropped a little bit. So our ability to step in and buy value, because more often than not, you make money in commercial real estate when you buy it, you cash the check after you execute the strategy. And these are things that we're going to do that give people just a short journey to collect on their investment, rather than something where, look, we can make that kind of money, but it could take you 5 or 10 years if you use a different strategy. So we're going to kind of break down the ones that get you there the fastest today. We're going to show you how it's actionable for you, no matter where you're from, and how you can do it a number of different ways. And, we'll dig into the details.
I've heard you say a lot of times that more millionaires have been made through commercial real estate than any other investment vehicle. Now, if you're going to come onto this podcast and say, look, I'm going to show you how to make $1 million in the next month in, alpaca grooming or in, reverse swaps on Iraqi dinari, okay, that's one thing. But commercial real estate is a tried and true wealth building mechanism. And I've seen you train tens and hundreds of thousands of people over the last 20 years. And I've seen people actually achieve this kind of success where they've made, frankly, more than $1 million. I think $1 million is a modest goal, but I think that's a nice round number. It looks good on the YouTube thumbnail, right? So everyone can see it. So let's get into this. Okay. I want to make $1 million in the next year. Let's say I'm just your average guy. Maybe I've done a house flip, or I have a couple stocks. I don't really have a large asset base. I don't have necessarily great credit, and I don't really have any experience. What can you do for me?
Well, we can do a lot. Again, in this business, you don't need any money. You don't need any credit. You don't need any experience. But what you do need is you need an environment where you can learn and you can grow from other people's experience. People that you can rely upon that are going to give you relationships, they're going to give you strategies, they're going to give you access to, let's say, different methodologies for construction and building and improvement. Again, a lot of times what we're doing is we're really just upgrading the general impression of the asset, right? Making it look a little better than it has because it's got deferred maintenance, it hasn't been maintained well, somebody kind of lost it, they lost interest in it. These are opportunities for people to step in, and so the truth of the matter is the asset itself brings so much of the means to acquire it, right? So usually 60, 70, even 80, 90% of what you're going to need to buy that asset is inherent within the performance of the structure itself. If it's got cash flow now, you can leverage that cash flow and return some of it back to the seller in a way that gives them a cash flow without the burden of owning and operating that property. If the property's not performing at all and it has no assets, but you've got some ideas about how you can improve it, how you can make it worth more, how you might be able to fill it with other tenants, because it's bleeding money right now, you can step in and act on it without necessarily having to buy it up front. And then one of the third strategies we'll talk about is how you can gain control of a property without actually taking the full risk of taking ownership, and how you're going to be able to market that asset, and only if successful will you finally close on it. So those are 3 strategies that I think we're going to unpack today and we're going to get into that allow people to get started. If you have no money, no credit, and experience, you can do it. If you have some of any of those things, every little bit's going to help you along that journey. But when I got started, I had a 500 credit score. I had never done any real estate of any kind. I didn't even know what the true definition of a mortgage was. And last but
A
certainly,
mortgage, it's what you measure it's a
Your
gauge
mort
you measure your mort with, right?
Right, exactly. And so, in the end, it was really about getting started and starting to digest information. And back in the late 80s and early 90s, that information was pretty hard to come by. There was old books that you could get in the library. If you wanted to go find information on real assets, you had to go down to the recorder's office. You had to drive neighborhoods, and you were knocking on
Sounds
doors.
awful.
It was tough.
Yeah.
Today, all that information is available to you at a fingertip. You can get it online. You can get databases that are available. You can get involved in networks like the Commercial Academy, and there are others out there as well. But by doing that, it's such an accelerant because that specific information has been filtered down and it's distilled in something that is digestible and actionable in the near term. And so we focus on giving people this 90-day action plan that they can focus on. They get to pick the scale, the location, the asset class, how much time they have to put into it, how much risk they take, if they're going to be able to qualify for a loan or not. And all of those things basically just continue to lead you like, water finding its own level to your action and execution strategy.
So before we get into strategy 1, although I really like the sounds of strategy 3 where I just don't have any risk up front. Before we get into strategy 1, a lot of people are going to hear, they're going to click this and they're like, I want to make $1 million in the next 12 months. But then they're going to hear you say commercial real estate and they're going to have visions of skyscrapers and unattainable deals.
Yes.
Define commercial real estate, what that even is. What is the target here? Because I think a lot of people can wrap their mind around, I'm going to flip a house.
Yes.
Or they're going to, I don't know, buy a franchise of a donut shop, right? They can wrap their mind around that. But when they hear commercial real estate, they pucker up and they're like, I don't think that's for me.
Yeah, well, no, it's an intimidating concept. Most people can't even spell the word commercial. Okay?
Right.
So let's go with that.
Chimerical.
Yeah, right. Chimerical. And, obviously it's intimidating because you're dealing with something from a non-consumer protection standard, right? So you're in commercial real estate. It's kind of caveat emptor, buyer beware, and all of that stuff. But the reality of it is it's just income property. It's like property that's value is based on its income versus residential, which is, look, it's a commodity. It's housing. It's something that people need. So in commercial real estate, what we focus on is what we can rent it for, what it costs to own and operate, and that's not including debt. And what's left over is what's going to dictate the value. So there's not this murky sort of understanding what something's worth, right? It's literally based on the revenue that it generates. So if it's generating income, it's got some value. If it's not generating income, of course the bricks and sticks and the land have value, but it's really diminished over what it would cost to build that or to replace that asset. So from a commercial real estate perspective, it can be something very small. A 5-unit apartment complex is a commercial asset. A single tenant standalone office or retail facility is a commercial asset. Even a piece of dirt with nothing on it that's zoned for industrial, retail, multifamily, office is commercial. So the thing that makes that valuable is that the bank is going to underwrite it or any buyer is going to underwrite it based upon income. So if I have 2 assets that are identical, built the same way, same time, same year, same blueprints, in the exact same condition, if one's occupied and one's 100% vacant, the one that's occupied is worth 4 to 10 times as much as the one that's vacant. So we've got to find quick fixes. Like we can get a tenant for this space, and if it's multifamily, you just got to outcompete the market. If it's cleaner, if it's safer, if it's more attractive, if it's properly priced, you're going to fill it up. And in so doing, just by getting a couple of those units filled, you can make a lot of money. People don't understand an $800 a month unit. That translates to $100,000 value for one unit. It's a big deal.
Would it be fair to say that in a sense, with single-family homes, you're buying a commodity, you're buying something that's based on comps. But when you're talking about commercial properties, in a sense, now I know that there's some qualifications being that there's actual physical property involved, but it's almost like you're buying a business because you're buying a cash flow. Is there some
validity to that?
Validity to that.
Yeah, I think more so than people realize. And so what we do is it's kind of one of those crazy things. It's almost like making a motion picture, right? Where you bring a team together and you got all these talented people and they come together and they work really hard for a small period of time and then they disband because they've done their job. In commercial real estate, it's very much the same way. What happens is you come together and you've got an objective. Our goal is to fill the building up. It's to to improve it with cosmetic upgrades. We can change its use. We can raise the rents. We can operate it more efficiently. Whatever that strategy is to create that value, you get in, and more often than not, what we do is we start a company that will specifically be created to own that building.
Okay.
Once we do that, we create an operating statement. How did it cash flow? Did it generate any money? What were the expenses? When we collect all the rent and we subtract all the expenses, that bottom line number is basically considered a cash flow. And you then offer somebody a return on investment. And so what we always go with to keep people, easy is, well, what if you got a 10% return on your money? Well, if it's throwing off, let's say $15,000 a year in net income, right? After you collect all the rent, pay all the bills, there's $15,000 left. At a 10% return, somebody's willing to give you $150,000 to buy that asset. Well, if you add just 3 or 4 of those units together, well, now we've got $450,000 to $600,000 worth of assets. And so it doesn't take a tremendous size of asset to create real value. And in many instances, if you get into, let's say, a 10-unit count, if we raise our rents over the course of a nuisance raise, $25 to $50 per unit, you've created hundreds of thousands of dollars in value, and it's really invisible to your tenant. And most people don't understand that capitalized value. That's something that we can really impact.
Yeah.
That can be really impactful.
And I think all of the strategies you're going to share here, really at the heart of it, is capitalizing that value. And that's what I mean by that it's like buying a business, because your inventory is your square footage. Your inventory is your unit. And the more you can charge for that, the more you make. Whether you're doing an improvement, that allows you to charge more. So this first strategy, and we talked about this, as we were preparing for this is a strategy that you said now in today's economy and in today's market is really more realistic than it has been at any time in the last decade. So what is that?
Yeah, really almost the last 2 decades. So what we're talking about is seller financing or seller participation.
Okay.
This is where the individual owns the asset, and they really maybe they have a small loan on it, or maybe they own it free and clear, which more often than not is the case. They own it outright because they've held it for a period of time. Maybe they've gotten it through inheritance or through divorce, or
it's a long-term asset in their portfolio.
They've had it for a long time, and they've just they've fatigued out on it. They've tired of paying attention to it. It no longer holds the same, let's say, gravity within their overall holdings.
Okay.
And they're willing to let it go. Now, what happens is there's a huge tax burden that can come if they just sell it outright, because they probably don't have what they would call any sort of investment left in it that they can say, well, look, this is just me returning my cash. It's just all gain for them.
Yeah.
So for those folks to participate in a deal, over the last 15, 16 years, most of those deals have sold all cash very quickly with no concessions. In today's marketplace, banks are a little more, let's say, they're a little more hesitant to get involved because they know that there's a revaluation coming.
Sure.
Asset values are coming down off of the recent peak. Interest rates have risen. And so there's a lot of owners who bought when prices were at the top and interest rates were really low, creating this unique circumstance where they're underwater and there's no way to get their head back above water. I mean, it's going to be decades before they're okay.
Yep.
But in commercial real estate, your loans don't fully pay off. So if I get a loan, chances are it's a 3-year, 5-year, or 10-year loan, but I'm making payments as if it pays off over 15, 20, or even 30 years.
Sure.
So when that loan matures and the term comes up,
That's a balloon, right?
yeah, that's a balloon. I paid 5 years of payments on it, but it would have taken me another 20 years to pay it off in full. So now I've got to find replacement debt. If the interest rates have risen, and
I see what's happening.
you've overpaid,
Yeah.
now you're underwater, you don't have the ability to get replacement debt. You're going to have to bring new money to the table just to hold on to an asset, and almost nobody's in a position to do
So
that.
this deal made sense when 10 years ago I had financing at 3.5%, but now that financing's at 8%, the cash flow isn't there to cover the debt coverage, and I'm upside down. I got to do something, and no bank is willing to give me the money, right?
Well, and so the banks know there's a wave of that coming.
So-
because of that, they are nervous about values.
Got it.
But that doesn't mean that the person who owns that property isn't ready to sell. They can't wait for the banks to square everything up and, for the market to normalize and people to go ahead and invest. So what they find themselves in a position is that the banks don't really want their assets. And what we're finding right now is any apartments that were built in the 70s and 80s, even the 90s by and large, there's no debt for them. But those were the hottest assets in the last cycle. They were trading at 3 and 4 and 5% returns, which is crazy.
Yeah.
And that is a valuation that might never be seen again for those assets. But so many people saw people, turning those deals and flipping them and making money, but the banks know that that's coming back. So what that does is that means that the banks are cautious because they can't trust the appraisals that are going to come back. It's like, well, this one sold in 2019 for $100 million. So this one here, even though it's smaller, is worth $10 million. No way.
Yeah.
That $100 million asset's going to be losing half to 2/3 of its value probably.
It's catastrophic.
And it's gonna really upend the market, which is why you've seen such a marketing campaign to get people to start doing savings, right? The banks need cash. So they want people to invest instead of in fixed assets. They want you to buy their 4 or 5%, let's call it, money market, CD, whatever it is. But the sellers need to sell when they need to sell. So right now, the market is a buyer's market.
Yeah.
People are out there buying. So if you don't have a lot of capital resources or a lot of experience, you can make an offer and the seller is going to be willing to take back a huge portion of what you're going to be paying them in the form of a seller carried note.
Seller financing.
Seller financing. You're
Okay.
going to pay them a monthly amount to pay that down, usually some form of competitive nominal interest rate, 3, 4, 5, 6%, nothing crazy, competitive with banks. They're going to want some small down payment. That can come from partners. It can come from, let's say a couple of months of escrowed rents. It can come from your broker's commission. There's a lot of ways to form that capital. But the biggest chunk of that deal is going to come from a seller-held note.
Okay.
And that was how I got started in my career. My very first deal, 24-unit apartment building in my hometown. I had no money, no credit, no experience. Again, 500 credit score. I was making about $60,000 a year in my job. And I'd never owned a property before. And the guy was asking about $900,000 for the property, which might as well have been $900 million. Right, I didn't have that either, right? And I made him an overpriced offer because there was other people who were interested in the asset. So I offered him $918,000. He carried back 80% of that. He took back $740,000 in debt.
Why was he willing to do that with you?
Well, he was willing to do it because he knew the asset.
Yeah.
It was a building he'd already owned for 20 years. He knew where it was. He could physically see it.
Yeah.
I had to maintain insurance on it. And if I wasn't making my payments, all he had to do was come on back and get it. Now, he did have me put down a down payment. I had to go out and raise about 20% of that asset. It was about $180,000. That came from friends and family.
Okay.
That's really what it came from. And I raised that money by giving them a nice 10% return on their money, which I was able to demonstrate that the property's cash flow would be able to provide.
Right.
And because the markets were under rent, right? Because the rents were under market.
Yep.
I was able to raise those to market, which meant that, a $700 two-bedroom unit went to $900. Well, if I did that across those 24 units, that was a huge gain in value and a huge gain in income. My income went from about $72,000 to about $120,000 a year, which meant that the value of the property went from about that $900,000 to about $1.4 million.
So you
and
were able
I
to
did
use
that in about 3 months.
So you were able to use that cash flow then to pay off your investors,
right away,
handle the debt that you were paying to the seller.
Yep.
So you really didn't have to come up with anything out of pocket.
And I got $6,000 a month positive cash flow literally from day one.
And all you did was raise some rents and fix vacancy, I presume?
Yeah, we painted the hallways. We changed out some, carpet. The hallways, I think, were like 80 by 5.
Yeah.
So we changed out hallway carpeting, put some brighter light bulbs in. Back in the day, it was a call box security system. So we upgraded the lighting so it felt safer, it felt cleaner, it smelled better.
Yep.
Some plants on the outside for some curb appeal. And then when a unit would turn over, which they really weren't because people had lived there forever, there was a waiting list to get in, which is one of the reasons we knew we could press the rents higher. When somebody turned over, we went in and freshened up the unit, and now we got even a bigger rent bump than we were able to get from the tenants who were already living in the property.
So then we promised that you'd make $1 million in a year.
Yep.
Right? Now, I get that you were able to get this property under control.
Yep.
I get you were able to do it with no money. You were able to pay off your investors, pay the guy who is seller financing, pay your debt, and have $6,000 a month cash flow. Now, look,
$72,000 isn't $1 million.
$72,000 is $1 million. I mean, I'm not great at math, but I know that much. So how did you make $1 million in a year off of that?
Yeah, so what we ended up doing was I ended up renovating those apartments.
Okay.
And I needed to do that in a way that wasn't going to undermine my income. So I went to tenants who had been there for a decade or more, right? They'd been there for a long time. And Unfortunately, in the apartment business, what you do is you only take care of your new clients that you have no relationship with. Those are the ones that get the fresh unit.
Yep.
They get the new carpeting, the new paint, right? They get the better end of the stick. If you're stuck around for a decade, now your paint's old, your carpet's old. It's all kind of lousy.
Yeah.
So I went to those tenants. I said, look, if you'll sign a new lease, a 2 or a 3 year deal, I'm going to refresh your unit. We'll be able to do it while you're there. It'll be, unobtrusive. It can be done in a weekend. And they all took it. And so I was able to get a 5-year rent increase, and I got it done within my first 12 months.
Yeah.
By doing that rental increase, just like we talked about at the beginning, that rental increase allowed me to capitalize the value, and I was able to create that delta
Okay.
that made me about $800,000 on that particular deal. But I did one other thing. I went and I got new financing. Because the building was kind of done, I was able to go back and get better debt. The interest rate with my seller was 9%.
Okay.
And I was able to get about 6% interest from my bank. So I went back to the seller who still didn't want to pay the taxes, which was his motive
Right.
for seller financing.
Sure.
And I said, would you like to be a private investor? And he said, yeah, I'll be a private investor. So when I refinanced that building, I actually put $850,000 cash in my pocket. I still owned it,
Right.
and I still had a $6,000 per month positive cash flow. And I went out and bought my second building, which was a medical office building that I bought at auction, and I bought it all cash, so I owned it free and clear.
All right.
So not only did I make $1 million, but I actually made closer to $3.5 million in that first.
So with equity, cash flow, the check that you got, and then you were able. So you took the seller who was financing. Like he didn't want the money now because
couldn't pay the taxes.
The IRS would eat him alive.
And he wanted the cash flow because that cash flow was something that he had become accustomed to, even in that short window of time in that first year.
I'm sure Mrs. Seller Financing didn't want cash flow to go away, right?
Right, because she was using it to, kind of support the grandkids' lifestyle.
Right. So then you essentially turned him into an investor and rolled, because he didn't want to pay it all. So you took his money, instead of giving it to him and basically getting rid of his motivation, you said, okay, we're going to roll this into a second deal.
Yeah, we did a substitution
Wow,
of
okay.
collateral. It was cool.
Okay.
So I took that building and I said, well, what if you were just guaranteed by all the assets that I own in a personal guarantee? So I gave him a personal guarantee. And in seller financing, just know you're going to give a personal guarantee. You're going to have to look out for the individuals that are, let's say, going to be taking a shot on you. So you're going to give them key man insurance in case you forget to look both ways when you cross the street. They get paid out, and your heirs get the asset. You're going to give them an operating covenant that says, look, if this thing goes in really bad shape, you just get to claw it back, and you get to keep my down payment, which is something that's going to motivate you, and it's going to inspire them to have trust in you. And then last but certainly not least, if things really do unravel, they get their property back, and it's an asset that they've owned and they know really, really well, which I find with, let's call it senior investors, folks who are, of retirement age. They're not interested in rolling up their sleeves and getting dirty with new assets and starting over. They just rather get income to continue to come in without the risk, the burden of responsibility, knowing that they're going to be able to have that tax shelter and that cash flow for a period of time.
Funny thing about that property is that was actually the first apartment I ever rented.
Yeah, it's true.
I mean,
remember.
so you probably had a vacancy. You're like, well, I'm going to the bank and I need to have some guy come in here and pay this rent. And I'm sure you didn't give me a tax or a rental break. I'm sure you did to Ritzy Banis, the 80-year-old woman who used to yell at me all the time because she said leaving lint in the dryer.
You did leave lint in the dryer.
The
I know
hell
it was
I
you.
did.
I
The
bet it
hell
was
I
you.
did. No,
Yeah.
it wasn't. And Ritzy Banis, God rest, I'm sure she's passed. She was
Wonderful
she's a
woman.
wonderful woman.
She was my mole. She let me know what was going on. If
She
people
was-
were not, if you're
Sister was a rat.
if you were washing laundry and it wasn't your day, I knew about it.
Well-
if you had a dog, if your girlfriend slept over, I knew.
Well, Ritzy's in the great beyond right now. Now I think she can see that it wasn't me leaving because I am a habitual cleaner of the lint trap. So Ritzy, no thank you. But yeah, that was my first apartment, and I'm sure that just a 22-year-old jackass like myself who could not really afford an apartment, but enough.
Yeah.
That one single lease that I signed with you increased the value of that property. How much?
Oh well, I mean, it would at that point in time would have been about $1,000 a month.
That's about right.
$12,000 a year. Figure 50% expenses, so that was $6,000 net. At a 5 cap, that's $120,000 value created for that lease.
You're welcome.
You're welcome. I appreciate you. Thank you, man. Yeah. It helped me pay you for seal coating and striping that parking lot.
Right?
And so what happens is we try and tell people if you can get involved in an asset that's usually 20 units or more at a minimum, it gives you that scale of economy to be able to really build a rent roll where a single stroke of your pen again, just think about, the fact that we would do a modest rent increase is now multiplied times 24.
Yeah.
And that's multiplied then again times 12. And so, like we've talked about, every square foot is a unit of inventory, but in multifamily,
It's a unit.
every unit
Yeah.
is a unit of inventory. But most people say, well, 2 bedrooms a 2 bedroom, but that's not really true. There's
Sure.
a lot of differentiators. This one has a bigger second bedroom. This one has a better view.
Closer
This
to
one's
the
closer
door.
to the elevator,
Yeah.
whatever the case may be. This one comes with covered parking, right? And so you create those differentiators that are stimulators to add additional income and revenue. But that was a great way to do it. And if it wasn't for that seller financing, there's no way I would have bought that thing.
Sure. How could somebody find a seller who's willing to finance? What's a couple just easy ways, briefly, that they could find someone who would seller finance the deal? Because what am I just going to knock on them like, hey, you want us to give me a loan? I mean, how could I approach
It's a great
an
question.
owner of a property and have him take a shot on me?
Well, it's a great question. So what we always tell people to focus on is hold times. If someone's owned that property for 15 to 20 years or longer, you know that the tax code favors them selling to you on an installment sale with seller financing.
Because they have the capital gains looming and all
Because
that.
they're gonna pay that big thing. The other thing is that they're probably a little older, because the average person starts investing around the age of 49, 50 years old. That's when they really start getting involved. They're looking for more fixed assets.
Sure.
By the way, if you're ahead of that age criteria, then good for you, because you're in the game earlier, and time is your friend in this business. So there's those.
But if they bought it at 50, 15 years down the road, you're staring retirement in the face, right?
Absolutely. And cash flow is what people in retirement are concerned about. They want to
Yeah.
make sure that they can cover their bills, that they can take care of their family, that they can, take those discretionary trips and things of that nature. So hold periods is one of them. And then, honestly, it's as basic as this. You got to ask.
Yeah.
You miss 100% of the shots you don't take. is
Wasn't that
the old
Michael
quote
Scott?
by,
That was Michael Scott, right?
It was Michael Scott. Quoting Wayne Gretzky, by the
Right.
way. And so if you don't ask for it, you'll never get it.
Okay.
Right? Now,
So I would just go and look up property records and say, look, this one's been held, last transferred 15 years ago.
yeah, and find out what they bought it for. I'll tell you, one of the things that you're going to find right now in the marketplace are people who bought properties within the last 3 years who are underwater. Try and be very cautious. So they're going to look at it and say, well, they bought the property for $1 million, but today they might be selling it for $3 million. And you think 3 is a deal until you realize they just paid $1 million for it and really didn't do anything.
Yeah.
So you want to be cautious about the assets that you're going to pursue, and yet I will tell you that seller financing is a catalyst for so many people to break into this business.
Yeah. Because, I mean, look, the idea of having to go to a bank and having them probe and prod every crevasse of my life and personal being doesn't sound terribly comfortable.
Well, and I'll tell you what, right now they're not even authentic in their interest. So
Sure.
you're
They don't
gonna
want to
spend-
give out loans.
You're going to spend money. You're going to go through underwriting, only likely to get some sort of a denial based upon your lack of sponsor experience, your lack of liquidity, or worse yet, your credit score. So we put those things out there, but those things are easily overcomable. You
Yeah.
can easily achieve what we're trying to do here by going ahead and finding these deals. And
And these don't have to be properties that are listed for sale either.
they should, in most cases, they shouldn't be. In fact.
Okay. So you don't
wanna
want to go
find
say,
stuff-
hey, this one's on LoopNet or whatever, and this one's listed for sale and it's transferred. No, you want to find a property that's just sitting there not listed for sale, right?
Well, and I'll tell you right now, brokers are more open to presenting those offers than they've been in the last probably 10 years.
Brokers are
But
hurting too.
But it's still not the best way. You're
Yeah.
better off going face to face with the principal decision maker who can decide, yes, that they want to do business with you, or no, they don't. Off-market deals are always better.
What's the worst they could say, no?
That's why you're looking at those 15-year, 20-year hold periods or more.
Yep.
And again, you want to do it, and I would tell you, you don't want to do it in slummy areas. You want to make sure it's Class B or better. So Class A is that brand new stuff with all the amenities, the pools, the dog walks, the barbecues.
That's probably not even going to be old enough to apply here.
You're not
Yeah.
even going to get this. But Class B assets are stuff that's older but well maintained. The Class C stuff are things that are in war zones where there's drugs, prostitution, rock and roll, gangbangers. Stay away from that stuff. It's
Yep.
too hard. Nobody wants it. It's cheap to buy, but it
Not
also
even the
doesn't-
rock and roll and drugs. Can't keep that at least.
Can't keep the rock and roll. Can't
Like
keep
maybe
the
like a
drugs.
B minus and get a little rock and roll.
Maybe a little rock,
Okay, a
but
little
no
rock.
drugs, right?
Okay.
And so I think the idea for us is to say, look, you want to serve the marketplace with what you're creating. You're
Yep.
you're not going to try and buy the cheapest thing that you can get your hands around, because you can't force that value, that appreciation. You'll get better cash flow by raising rents, but it won't be worth more because
Got it.
you can't change the location. But if you can get involved with those, those middle of the road, blue collar area assets where people have pride of ownership, They take care of themselves. They take care of their cars. They go to work. It's affordable. They're upwardly mobile. They're trying to, make it to that next rung on the ladder. You're going to get reasonable turnover every 2 to 4 years. You don't want people living there forever.
Yeah, because it's harder to raise
It's harder
rents.
to raise
Yep.
rents. And you don't want people who turn over every year because your expenses start to
Sure,
climb.
because you have to swap over the unit and make all those renovations.
Absolutely.
Every month.
And so that's not ideal. But by being able to focus in that category with those types of assets, seller financing is really going to be prevalent. And it's going to be easier and more ideal for both parties. It's going to be quicker for you to close, and it's going to be more streamlined with the terms with the seller.
Seller financing sounds like an easy way to get into property. Now, an easy way to get into the content of the Huge Profits podcast is to go and click the like and subscribe button. It's free, right? And if free isn't good, I don't know what is. All you have to do is click the button. That way you'll make sure that you get every piece of content that Scott produces here for the Huge Profit podcast. You can see us on YouTube. You can see it on all the major podcast players. And you can go to the website, commercialacademy.com, to learn more about all the programs that he has and all the different social media accounts that you could follow. Now, Scott, number one, I get it. Seller financing. Love it. Sounds like that's something that a lot of people could take advantage of. And it makes financing and getting that property easy. And I get the idea of the substitution of collateral, which gets you that first million.
Yep.
What's the second strategy we want to talk about?
So the second strategy is if you find assets that are really not a great fit for your skill set, not a great fit for your finances, or your experience level.
Yeah.
Okay. So when we get into those types of assets, that's where a nurturing environment where you're going to be able to find partners who are going to empower you because you brought a quality opportunity to them. I'll tell you that probably 8 out of 10 of the folks that we work with who have not done a commercial asset before break in through partnership.
Makes sense. Yeah, I mean, look, if I were, I could probably handle an apartment building. I could probably handle a couple house flips. But if I wanted to go and get a, 35,000 square foot retail center, I wouldn't want to do that on my own.
You really shouldn't.
I shouldn't.
Yeah, there's really no reason for you to own your first asset 100% on your own.
Yeah.
You're taking inordinate risk. You're going to have such a steep learning curve.
But the
that you're-
profit window of that could be tens of millions, right?
Absolutely. No, you're talking about many multiples of millions of dollars
Yeah.
plus great cash flow.
I'll take $1 million
Plus
if I
good
bring
leverage.
that to you, right?
Absolutely. And so what happens is if you bring that upside value in the right markets, now what happens is, the key is get it under contract, get it under control, and then we do a thing at our events called an op swap.
Okay.
So you bring an opportunity, you talk about what the deal is, you talk about, what your execution strategy is, and then people literally start to, bid to become partners in that deal. Some people will say, look, I'd like to be a lead partner with you. Other people say, look, I believe in the deal. It makes sense. So here's $50,000 or $100,000 to close, and let's ride this thing out together over that 1 to 2 year investment horizon.
But so this is not bird dogging. I'm not just trying to find leads and flip them to someone. I'm actually trying to maintain a part of the deal, but have somebody else with experience or more resources make it possible.
Well, they're
correct?
going to shorten the learning curve.
Yeah.
You could flip it, so that's an option if you decided to go that way. But we always encourage people in the beginning to try and hold on to a piece of equity within that deal. You may want to get a finder's fee right away, or a sponsorship promote, we call it, which is we get paid for putting the whole deal structure together, creating the vision, putting together the blueprints, and maybe a quick little executive summary on how the investment should perform to raise money. So you'll get some compensation for that.
Sure.
But long term, we always feel that the better way to get paid is in the long-term capital gain mode, which means you've held it for more than a year. So your taxes go from about 40% ordinary income down to about 15%, which is phenomenal. And you get the opportunity to share in the big upside. And most often what happens is once you finish the project, you don't actually sell it.
Sure.
You refinance it, which means that all of those proceeds of the value that you've created, or 70 to 80% of it anyway, is going to come back in the form of a loan that's going to be paid for by your tenants who have guaranteed leases, or there's a backlog, like we said, of residents that want to fill the building. And when you do that, that's all tax-free money that you get to spend today.
It sounds like a lot of these strategies are essentially solving the bank's problems for them, and they'll reward you in the form of a loan.
Well, it will, and once it's stabilized.
Stabilized.
Once it fits
because you
into their
fix the
box.
bank's problem.
Right. Once you fix that underwriting problem for the bank.
Because banks exist to lend out money and make profit off of lending money, but they have to have something worth lending on, right?
100%.
So if you could fix a bank's problem and say, look, I solved your problem, they're like, this is why we exist.
Yeah, more often than not, that's true. In different lending environments,
I know that's an oversimplification.
well, no, it's not even that. What I'm trying to say is that in different environments, there are holes in the marketplace where even if you've done everything right, the bank will still not finance it.
Scumbags.
They really are dirtbags. Let me just put it out there.
Yeah.
There's no loyalty. There's no relationship. And the way that they write their documents today compared to the way that they were back in the 1970s, they are so constraining. The bank can act with impunity. They can act with bad behavior. So we always talk to people about getting non-recourse debt, where the worst thing that happens is they take the asset and you lose some of your equity. By that point in time, you'll have pulled 70, 80% of it out. So it's not the worst scenario. But in general, we're coming into one of those windows right now where banks are very hesitant to lend. And I want you to know that that's something that we actually seek out. We wait for these seasons in the marketplace that give us the opportunity to transact when most people have to sit on the sidelines.
Yeah, it's like a lion waiting for the weakest gazelle. Look, I don't have to hunt down the whole pack. I just got to wait for the weakest one, and I'm going to eat pretty well.
And that's the truth. So many people are in trouble, but there's a negotiating window that's going to come. So if you keep your eye on a marketplace and your eye on an asset class, you're going to find opportunities to get in light, opportunities to take over existing assets without bringing a dollar to the table, seller financing, or like we're talking about now, deals that you can bring to other partners, all of which are great strategies for you to get in regardless of your income or experience level.
All right, so if I find a deal, let's sum up the strategy. I find a deal and I bring it to you. It's not a deal that I can bring down. I'm not a big enough lion to bring down this gazelle.
That's right.
I bring it to you because you got the big jaws, right? Then the wild mane, right? How do I make $1 million off of that? What's that scenario look like in the next 12 months?
So what that looks like is you bring that deal to the table. Chances are you're going to get a piece of equity and you might get a finder's fee.
Okay.
Those finder's fees, we just had a young man who found a 60,000 square foot single tenant deal. He flipped it for $1.8 million.
Okay.
So it was a nice flip.
Yeah.
Right? I think he's 27 years old. Good guy.
So he flipped the deal to you?
He flipped the deal to one of our other
investor
one of our
groups.
other investors, and so he was able to do that just on a quick flip. But for us, what we would say was we'd have you come in on the deal. Now, the deal's got to be sized right for your equity stake to make you $1 million.
Sure.
Okay?
But you could flip the deal and maintain a little equity too, right?
Well, you should.
Okay.
And that's what we're going to advocate. We're going to advocate that you're going to at least try and keep 20% of the deal.
Got it.
So if you keep 20% of that upside, I think you used the example of a 35,000 square foot retail center. In most markets in the country, that retail center will lease for between $10 and let's say $20 a foot. So let's run it right down the middle. That's going to end up yielding for you about $525,000 a year in gross rents.
Yeah.
On a retail plaza, that $525,000 in potential gross rental income is done on what's called a triple net lease arrangement, which means that the tenant actually reimburses you for all of the expenses.
Okay.
So if we can find the users to fill this space up, the expenses don't cut away from our income. They're actually supplemented. So they'll pay the cost of taxes, insurance, landscaping, those types of things.
So does
In
triple
addition
net
to the
just mean
rent.
3 things, or is that colloquialism?
It could mean 3. More often than not, what it means is it's recoverable expenses and it is fixed operating costs. So again, taxes and insurance and then property maintenance. When they reimburse you for that, that $525,000 in total gross rent, and let's say that we get it to, I don't know, let's say we get it to 80% occupancy. At 80% occupancy, we're going to lose 20% of that 525, so we're going to lose, let's say, $100,000.
Right.
So instead of being at 525, we're now at 425.
All right.
Capitalized value puts that at between $6 and $8 million. Now, depending on where we bought it, and we'll know that up front, that's where the value comes in. We buy assets. That asset, 20, 30, 40% occupied, you might be able to get it for $1 to $2 million.
Right.
So we've been able to create $4 to $6 million
Just by buying it almost.
Just by buying it and knowing that we can backfill it.
Yeah.
And in those types of facilities, it's really the facade. There's not a lot because the tenant brings the inside.
Okay.
So they're easier to rehab than single-family homes. Clean up the parking lot like we did on that first apartment
That's right.
building. Maybe get some new signage and some landscaping. Paint the front of the facade. Paint will make it what it ain't.
Yep.
And now you're back in business.
Okay.
You'll pay a broker between 2 and 6% to find you a lease. you can get those things done, especially if you buy it right, because you're going to be able to outcompete the market on your rental rates. Fill that thing up, and we've made a career out of doing those.
Now, getting into this last strategy, this was the one that appealed to me the most, and it seems like the most straightforward. So what is that third strategy that I could use to make $1 million in the next 12 months?
Plain and simple, it's options. So
Okay.
what you do is you go out and you make an offer on a property contingent on some future event. Either you're able to fill it up, you're able to find a new user, you're able to take a piece of vacant land that isn't generating any income, and you get it under contract so that you can see what can be done with it without taking any risk. It's simply the best way to get involved if you don't have a lot of money, you don't have any credit, and you don't have any experience. You're able to control a property with a contract, usually for 60 to 90 days. In some instances, I've been able to control properties for upwards of 18 months while I'm putting together a development program. And it gets very, very simple form. It's an option. You give a little bit of option consideration, $1,000, $2,000, $5,000, maybe $10,000. And then oftentimes what you'll do is you'll commit to a small cash flow. So I might find a retail center. It's got maybe 1 or 2 tenants. It's got room for 6. So it's got a lot of vacancy. It needs some work. You're going to get in there with elbow grease. You're going to be able to get some stuff together. You can do master lease options, which allows you to act as if you own it without actually going on title.
Okay.
And if at some point down the road it doesn't look like it's going to work out, you just get to give the property back and you let your option expire.
You're dating the property.
You really are. You're not marrying it by any
Okay.
stretch. And honestly, if you're at risk, you should date it first to figure out if it's got any real problems.
Right, okay.
So that's been a strategy that's been able to be utilized, and we do so much right now with what's called single tenant net leases. Think about, you drive by this old building, on your way to work all the time. Man, somebody should put a bank there. Somebody should put a gas station there.
Yeah,
Well,
everyone knows that property. Like, dude, if that was there, I'd go there all the time, but
Right.
it's just sitting there dead.
But I got to go halfway across town to eat a sandwich, right?
Right.
So the idea is when you know what those are, we do a ton with those national credit tenants, and they're looking for those sites.
Those are so easy to spot, too.
They're easy to spot. They're on the roadside. They're at the right location. They're at a hard corner with a signal traffic light.
Yep.
There's good traffic count. There's 20,000 cars that go by a day. It's in a decent community, and yet nobody's doing anything with
Yep.
it. Going ahead and getting that property under contract with an option gives you the ability to go out and market it to see if it's worth closing.
So I'm going to date it in the hopes that someone else marries it?
I think what you're going to do is you're going to date it in the hopes that it becomes what you thought it was.
Okay. So how would I make $1 million doing that? Because if I'm getting it under option,
Yep.
do I have to buy it? Or
You
if I want to make that $1 million, what would I do? Flip it?
Yeah, you could either flip it, you
Okay.
could close on it, knowing that you've got the tenant in hand.
Got it.
So
Oh,
you wouldn't-
that's important. Okay, I didn't catch that at first.
Right, so you won't close on it unless you've actually secured the tenant.
Okay.
Same thing with that multi-tenant facility. So if we've got that one where, like we talked about, hey, there's 2 tenants in it, but there's room for 6, that means that asset's probably losing money every month.
Okay, so look, I'm not marrying this unless she gets a haircut.
Yep, unless I
Okay.
can polish this thing up and make it look really good.
Got it. Okay.
Right, so it's kind of those fixer-upper type things.
All right, so if I'm looking at this property, and we all know them in our hometown, okay, this property is right there, makes so much sense to put a Dunkin' Donuts in there. I'm going to go get an option, and I don't buy it unless Dunkin' signs a lease.
Right.
Which
Unless-
makes me the money.
Right, unless they really want that site. And here's the good news. Those tenants don't hide what they're looking for.
Of course not.
They're going to tell you what side of the street they want to be on. Are they the breakfast side of the street or on the dinner side of the street?
Yep.
They're going to tell you how many square feet they need and how many acres the site needs to be. They're going to tell you what the median income and what the population needs to be. So all of that information is largely known by you as you're, going out and prospecting for who the user could be. What I would tell you is it's a fixer-upper. It's a value-add opportunity. In my experience, it's kind of the way that women date men. They're like, I could really make him into something.
I could fix
right?
him.
Right? I think I could change this man into
Yeah.
something worthwhile.
Yeah.
And so if you can look at it from the fixer-up perspective as opposed to, hey, the way men date women is I hope she never changes. I hope she loves me like this forever.
Yeah.
I think you're onto something really good.
Yeah, what's the old saying that men hope women never change, and they always do, and women hope men will change, and they never do.
Right.
Yep.
That's how it works.
So here's something else that you could do. This is a really easy and free option. click the like and subscribe button. If you're watching on YouTube, make sure you're clicking the bell so you get notified whenever new content gets released. If you're listening on any of your favorite podcast players, make sure you're clicking that subscribe button. That way you will be notified when the new episode comes out. And you can also go to commercialacademy.com and see all the different training programs that Commercial Academy and Scott offers to help you find more strategies like this so you can make that $1 million in the next 12 months and have the support to do it. So like Scott, this is stuff you teach your students all the time. How could they get involved with you through this and learn more of these strategies?
Well, this is absolutely what we do. This is how we get people to really get started. We've talked about the 3 basics of seller financing. We've talked about partnership, and then we've talked about options. Those 3 in and of themselves are varied enough that you're going to be able to create multiple opportunities, different pay windows. You get finder's fees, you can get equity, you can get cash flow along the way. And these are things that people can do with no risk. They can do it with no credit, no ability to bring capital to the table. If they click on the link or they go to commercialacademy.com, we've got events, we've got live trainings, we've got software, all kinds of tools that you can use. We've got a great community of folks who are looking forward to working with you, creating opportunities for you, giving you resources, accelerating your career by decades, really, to allow you to make this first year incredibly productive, again, while not doing it at the exclusion of everything else that you're doing right now. You don't have to sacrifice family, your current career, or any of those things. But the sooner you get started in this business, the happier you're going to be. And that's the one thing we find that's universal. Everybody who gets involved in this business, the only thing they wish they would have done different was they wish they would have started sooner.
Well, I know a lot of people out there are going to have a really exciting year if they do take advantage of any of these strategies. Because look, a year can change everything in your life. And a year from now, if you got started today, a year from now you can have $1 million. What would you wait for? Would you wait another year to do that?
No way.
When's the best time to start?
Yesterday, but
Right.
since that's not possible, do it now.
All right.
I think we also find that what's going on in the economy today is going to give you that unbelievable opportunity. So it's not really optimal for them to wait for that reason too. So you're going to want to have started sooner, but this particular moment in time is about as good as it gets.
All right, I learned a lot from this. These are some really simple and powerful strategies. I hope everyone else got as much from it as I did. I always appreciate getting the opportunity to hear you talk about the things that you do. So, thanks for having me on and thanks for sharing all this.
Well, thanks for being here with us, and thank you for joining us on the Huge Profits podcast. I look forward to seeing you on the next one. God bless.